Friday, July 26, 2024, Monaco 64, home of alternative economics and contrarian views. Hi, Clive. How are you?
Hello, good morning to you, Mario. I'm very well, thank you. As you can see, it's a very bright day outside.
Yeah, here as well. We've got
Just
summer finally.
outside there.
Yeah, summer has finally arrived here too. And Clive, I've got a little book here. I didn't show it to you before we started, but it's called The Pocket Book of Gold by Jim Sinclair, who unfortunately passed away last year. He was
Hmm.
considered Mr. Gold in the 70s and 80s. He did really well in that bull market. And there's a section here that talks about gold being a revealer of falsely stated wealth. And You sent me a chart yesterday comparing gold to stock market indices year to date. And so that's what we're going to look at today, how surprisingly gold has done really well versus the not just the NASDAQ, but also the S&P and the Dow, and you've got also the Russell. So I'll let you take over and tell me and the viewers what you think, and then we can look at some. You've got some charts, and I've got some charts as well later on.
I remember at some point back in the 2000s, I thought it might be a good idea to measure my portfolio value in gold because I thought that gold was more of a real money than the pounds or dollars or Swiss francs. I didn't like the result because I was making literally when I measured it in gold, I wasn't making any money. So yeah, put it back into the fake money, the fiat money, and I obviously that looks very very attractive.
Yeah, and yeah, were you looking so you put it back in Swiss francs or dollar?
Well, in the early days, and we're going back to the 1980s, it was in pounds. I mean, there was a period in the UK way back when I started investing, we still had exchange controls, so investing overseas was just not an option. You couldn't do it. There was something called the dollar premium. That meant that the British pound had two prices. It had the official rate of exchange, which was if you went on holiday and you're allowed to buy £50 of foreign currency in those days for travel, you would get the official rate of exchange, which meant that you weren't getting nearly as many dollars or Swiss francs, whatever it was, as you were. But if on the other hand you were investing, you had to pay, and you weren't allowed to do this without permission from the Bank of England, but you had to pay a massive premium. Or if you bought your money back from another country like South Africa, you could go through the dollar premium and get a nice profit. But they had a period when some wily Brits had discovered there was a magic trick to buy gold in London at the London bullion market price in pounds, export it to Switzerland illegally, of course, convert that gold into Swiss francs, convert the Swiss francs back into pounds, where you could get a lot more pounds in Switzerland than you could in the UK, bring the pounds back to the UK and buy more gold, but you end up with a lot more gold than you started with.
Well,
So that's in the end they had to get rid of these exchange controls and the dollar premium because there was too much smuggling going on of things like gold. I mean, there were people doing it through the back door as well. They were buying travelers' checks for holidays and not spending them and things like that.
yeah, I mean, people always find a way. So, do you want to start with your chart and talk a little bit?
Sure, I'll just share that, Mario. So let's share. I believe you can see
Yeah,
that now.
yeah, we can.
Uh, so what we're looking at, Mario, is since the 1st of January, uh, four lines. The line in orange is the gold price, and the line in dark blue is the Nasdaq 100. The line in red is the S&P 500, and the line in green is the Russell 2000, which is a small cap index. So what we can observe is since the 1st of January, everything is up. Uh, Gold, S&P, and Nasdaq 500 are all neck and neck. I mean, gold is actually doing relatively well compared to the wall. I mean, it's neck and neck at the moment since the 1st of January. So you wouldn't have done better buying the Nasdaq than you would have done buying gold. But what we do see is gold seems to be a lot more stable than the other indices. And right now we're going through a bit of a sell-off especially the Nasdaq 100, and even more so in what's called the Mag 7, the Magnificent Seven, which are the seven largest technology, well, they are technology companies in the United States. They're coming off fairly sharply. So they were a week or two ago, well ahead of gold, well ahead of the S&P, and they're selling off quite rapidly now. So the question is, has the bubble popped? And if so, how low will it go? And when does it recover? And what will happen to gold in this scenario? Well, in previous market crashes, gold has generally done fairly well, but things are much more correlated these days. So I think if the stock market is popping, and it looks like it might be, and I'm going to say temporarily, there's going to be no escape for gold or silver or literally anything. But it's likely that gold, silver will perform, or at least gold will perform better than the falling stock market. But I just want to turn for a second or two, Mario, to the line at the bottom, the green line, which has not been rising all year until about a couple of weeks ago, a week ago. That's the Russell 2000, the small cap index. So we've seen a huge leap in the Russell. It hasn't caught up with the mainstream indices of the 500, hasn't caught up with gold yet, but certainly there's been what we're seeing here is a rotation out of the large cap stocks, especially out of the Mag 7, into the smaller cap stocks, which are very undervalued. So the large cap stocks in the United States have got a price earnings ratio on average about 27 times next year's earnings. The small cap stocks have got a price earnings ratio of roughly 11 times next year's earnings. So they're a lot cheaper. And I think what's happening is people are starting to realize that a cut in Federal Reserve interest rates might be coming at some point. It's almost certainly coming this year. And that will be quite good for the small cap sector, they say, which is typically got some borrowings. Mary, I think you've got some longer term charts. Shall I switch back to you and you show the longer term charts of gold?
Yeah. Oh, Clive, just a little joke. I heard someone on X say that the Magnificent Seven are now the Miserable Seven.
Yeah, I mean, I think it
I'm not
made
sure
sense.
about it. We'll see. We'll see.
Yeah, to tell the truth, a week or two ago, I took some money off the table from the technology sector, and I haven't redeployed it. But if it goes a bit lower, I'll have to see what I do.
Yeah. So here, I actually got a year-to-date one as well, and I've got actually the Nasdaq Composite, and I've got the S&P and the Dow, and gold. Gold is the black line, as you can see here. So gold is since the beginning of the year is outperforming the Nasdaq Composite. I think you had the Nasdaq 100, so it's a little different. It's outperforming the S&P and outperforming the Dow by far this year. So to the people out there who have been stacking and are a little bit concerned about gold and silver for that matter correcting, yeah, don't, look at the bigger picture. It's not that bad. So yeah, you said about the long-term charts. I went back here 30 years and really interesting. So gold is still black, still the same colors. And you can see that gold is actually outperforming the NASDAQ 100 just by a little bit. I think, yeah, let's see. I've got these charts live. The reason I did a screenshot is because sometimes, oh, here we go. Sometimes bar chart will stop me looking at it. But you see, NASDAQ, that's gone up 2,173% in the last 30 years, while gold has gone up 2,226%. So even versus the NASDAQ over 30 years, gold is outperformed. It's outperformed the S&P, as you can see, and the Dow massively. And people might ask, why don't the fund managers in Wall Street and the people who manage your money tell you to buy gold if it's done so well? Well, I think it's because when you buy gold, especially physical gold, you're not using the financial system. You're not using the brokers and the Wall Street investment banks, and they don't get a fee, and so they want to keep quiet about it. So I've done silver as well. Uh, let's start silver. I've done it year to date as well versus those indices. So as you can see, silver is the black here. Silver has underperformed both the Nasdaq Composite and the S&P, but but not by much. We're still up 16.4%. And I think is it the nat the XAG USD. So there's some actually, yeah. Oh, is that silver? Yeah. So
Yeah, silver's up 16.4% this year.
yeah, and the other ones are up about a little more, but not much, 18%. The Nasdaq Composite about 20%. So you haven't done really that badly. The Dow is up only 6.97. It's only a longer term that silver has, it's still done well versus the S&P and the Dow for the last 30 years. It's only against the Nasdaq that it's underperformed. But as we see here, Clive, when we had the '08 crisis, silver did go down quite a bit, but then it picked up massively and outperformed the stock market quite a lot. And I know it's come down after that, but um, I think it shows, like you said, that if we see a crash in the major indices, doesn't necessarily mean that gold and silver are, well, they might correct, but they could outperform. And the same thing is, let's have a look for gold, the long-term one. Where's the gold long-term? Well, here it is. So yeah, that's when we had I remember this. We'd reached like 1,000 in gold in March of 2008. And then in September, when Lehman collapsed, we dropped to like below 700. But then, as you see as well, it completely, when they started QE, all the QE programs, gold went ballistic relative to the stock market. So that's how I see it. I don't know if you have any comments.
Yeah, well, I think there's a significant difference between gold and silver. If we go back to about 2013, 2014, something like that, as a consequence of the Hunt brothers cornering of the silver market, which pushed the silver price up to $50 at the time, a lot of silver started to come out of the ground. And that meant that the supply of silver, mine supply, was exceeding the consumption of silver. Now, silver, unlike gold, when silver comes out of the ground, it gets consumed and effectively, to all intents and purposes, destroyed because it goes into electronics and other things. It can be recuperated to some extent, but mostly it's destroyed. Whereas every ounce of gold which comes out of the ground goes into a big hole, comes out of one hole and goes into another hole somewhere. And so silver is to a large extent reflecting the supply and demand, whereas gold, supply and demand for industrial use and mine supply, whereas gold is reflecting the confidence that people have in the currency. Now, silver has that property too, but for many, many years, it was a forgotten metal and it was overwhelmed by the supply and demand. Now, in 2022, for the first time in a decade, the mine supply of silver was less than the industrial production, industrial consumption. And that's got the shortage of silver has got worse in 2023 and is forecast to considerably get worse in 2024 and beyond. And the reason for that is the use of silver in electronics and photovoltaic is rising very rapidly at the moment, and it is forecast to continue to do so. So silver, I think, is driven much more by the supply and demand factor. Of course, the monetary metal factor will come in at some point, but I don't think we're there yet as a monetary metal. But as people start to lose confidence in the currency, then it will definitely come into play as people start to hoard silver coins, just in case the currency fails. As far as gold is concerned, that's much more of a central bank play at the moment, where the central banks are saying, when the currency fails, and they see that as an inevitability down the line because all countries have become over indebted and it's unsustainable, they say we need to have something to back our replacement currency to restore confidence in our currency. Now, whether they actually physically back it in a way where you can walk down to the central bank and get your gold, or whether they just say we're backing our currency for the purposes of international settlements, doesn't really, we don't know which way it'll go. But if you want to have a currency system which continues after a failure, you need to have a lot of gold so you can promise this population we're now backing it and you can trust it again. And I think that's why central banks all around the world are starting to buy up gold. And the more gold they've got, the less they will need to devalue the currency, or the closer the new currency will be to the old currency in terms of what it'll be worth. So central banks are trying to get a lot more gold than they've got to have a seat at the table when we have the next Bretton Woods or whatever agreement is agreed to reset the world's currency system. What do you think, Mario?
No, I agree with you. Gold is a lot more of a store, a stable store of value than silver. And one of the reasons for that is, like you said, silver is consumed quite a bit. Gold isn't. And there's something that I'm sure you know about called the stock to flow ratio, which means how many years of production are above ground. And I'm going to share something with you here, and you can see that the stock to flow ratio for gold, and thanks to In Gold We Trust report, is around 66, which means there's 66 years of gold production above ground, which means that the new discoveries or of gold don't really affect the price that much, and that's why it's so stable. Silver, on the other hand, I just Googled here, the stock to flow ratio is 22, which means it's a lot less stable than gold. It's going to move up and down quite sharply, and I think that's why it's more volatile. And for other commodities, and that's why the other reason, Clive, when people talk, I saw Bobby Kennedy Jr. I didn't really listen to much, but he said, "Oh, if I'm president, I want to back the dollar with hard currencies." And he mentioned gold, but he mentioned platinum and other metals and Bitcoin. But um, uh, and even people who say, "Oh, the BRICS are going to have a basket of commodities," but the problem with commodities that are consumed, the stock to flow ratio is like a 3 months or a year. And so if you don't keep bringing the commodity out of the ground or growing the agricultural commodity, it's very volatile. And that's why, like you said, that's why gold is so stable. It's all to do with the stock flow ratio. So um, the other thing that I think might affect the gold price a little bit is jewelry demand, but that's very marginal, I would say. I agree with you that gold is reacts more on fear of the monetary system and what's going on in in the credit market.
Yeah, I mean, absolutely. The more people distrust that their currency will be worth something for their children or their grandchildren, or even to buy something when they retire, the more they're going to look for some alternative. And I think this is the reason why the price of the well, obviously, it's driven by the increase in government debt. It's driven by the increase in the money supply. But these things explain why the price of everything keeps rising, because collectively, the world is getting richer as the government gets poorer. And that basically means there's more around for people to buy stuff. And if you want to preserve your money in a relatively non-volatile way, but in a money form, gold is the way to go.
That's right.
Shall we talk about interest rates, Mario?
Sure, sure.
So I've just got, I'll just bring this share up. Share. Right. So this is people, everyone can go here. It's the CME FedWatch tool. And if you go to this, you can see that the next Fed meeting is going to be in 5 days' time, and that's when they make an interest rate decision. And we can look at the probability as determined by the market of a rate cut in July, on the 31st of July. And right now, the chances of a rate cut, according to the market, is only 6.7%. That's where my mouse is here. Whereas the chance that the rate stays the same, according to the market, is 93.3%. Now, that might possibly change. We've got the PCE numbers out today, the Fed's preferred measure of inflation, but I don't know if it will change. But let's just look forward a little bit. If I step, so I'm looking at July, the meeting in July here. It's marked up here. If I step forward to September, you now see that according to the market, there's literally zero chance that the rate will be the same. The figure over here is, oh, so I'll just go back in. The figure over here for the September rate is 5% to 5.25%. Currently, we're at 5.25% to 5.5%. So the market is giving an 87.7% probability that we will cut to by 0.25% in September. And there is still a 12% chance, 11.9% here, that they'll cut by 0.5% by September. And if I step forward to now we're looking at November, they're looking at a rate cut which should be 57, 60% probability, 0.5% to 0.75% lower. And that as we go forward, I'm stepping forward to December there, and I'll step forward to July next year. As you can see, it's the range of what the market is thinking might happen is quite spread out, but you see it could be anything, according to the market, from 3% all the way through to 4.5%. That's kind of where the market is putting. So let's just look at what this means. Why would the Fed think about cutting? And you and I have talked about probably they should be raising rates, I know, in the past, but they're not going to do that. They're going to follow the what they have to do to maintain the stock market. And I know that's not their mandate, but we've had a joke about that. But I think it's very true. The Nasdaq and S&P, as we saw earlier, are dropping, and the Fed will take that as a signal that ahead of the election they probably should be cutting rates. Whether they'll do it in July or September remains to be seen, but most likely September. Which probably means the market could carry on downwards right through to September. But certainly when we do get that cut, whether it's sooner or later, when that cut comes, it'll probably turn the market around and push it back up again. So whatever sell-off we're in, I think it's going to be fairly short-lived. The reason they are going to cut, there's several things. First of all, the job numbers are starting to come in not quite as good as they would expect. It's not that they're bad numbers at all, but we've seen the unemployment rate, which is currently at the quarterly number, that's the March number now, which is the latest number, currently at 4.1%, which is up from a year ago when it was 3.5%. So unemployment's starting to rise. They've got a problem in the housing market in the United States because anyone who's got a house has got what's called the golden handcuffs. Golden handcuffs mean that if you sell your house to buy another one, you're selling a house with a low mortgage rate. And when you buy the next one, you're going to have to pay a very high mortgage rate because interest rates are much higher. And that basically means that sellers who would otherwise be moving place to take a new job or whatever reason are not going to do that because they can't afford the new higher rates. And that's not good for the labor market. So again, the golden handcuffs of the property market might be if they lower the rates, might allow some people to move more flexibly. And it will also ease up a little bit for the buyers who basically are saying, I can't afford to buy a house either. So you've got sellers who can't sell and buyers who can't afford to buy. So the housing market is pretty much frozen at the moment in the United States. But in terms of when the rate cut comes, normally the Fed gives the market a signal well in advance of what's happening. We've got no signal at the moment for July, which is, as I say, only 5 days away. So my guess is that unless we get a signal in the next few days from the Fed, my guess is that we're going into a September cut.
Uh, I mean, I agree with you there. The other thing that could happen is that if they don't cut next week and the market gets really becomes, comes under a lot of pressure, and we saw in the last 2 days it has come under pressure. There's a possibility that the Fed could cut intra-meeting, and they've done that before. If from now to September, is it September 15th or 14th?
Yep, they could have an emergency cut,
Yeah,
couldn't they?
it's a long
It's
time.
been done before.
Yeah, just to let the viewers know here, this core PCE, PC price index, well, that's expected to drop from 2.6 to 2.5. So that's the expectation, the forecast. And the way they get this is surveying like economists that work on Wall Street. But if that number comes, let's say at 2.2 or 2.3, I think that could really put a rocket up the markets because it might give the Fed the excuse to cut next week. Because I think Jay Powell, Clive, he said in the past that we'll start cutting when we know that inflation is moving to 2%, not at 2%. And I would add, I don't believe in those numbers. I think the average person is seeing a lot higher increases in their cost of living. But as you said, I think the Fed's mandate, they say it's to keep full employment and economic growth. But I saw a meme and it had Jay Powell, and he said, my with a sign, my dual mandate is to keep the S&P and the Nasdaq near all-time highs.
Well, that absolutely must be his mandate in reality. But of course, don't forget the S&P and Nasdaq are to some extent a reflection of how people see the economy going. And every man who's got a job in the United States probably has a retirement savings plan, and that will be invested mostly in, for the most part, in equities. So if your house if your house price is rising, you go out and spend money. If your equities or your retirement plan is rising, you go out and spend money because people see that they've got the wealth to do it. If the stock market collapses, an awful lot of people are poorer, and they're going to rein in their horns a bit when it comes to spending and going on holidays and all sorts of things. But on your question of whether they have an earlier cut than September, if they do, my question will be this: what does the Fed know that the market did not know? And I think that would be, in a way, probably very worrying, because people are going to say, my God, they must have some data that they haven't told us, which shows that the economy is going into a big recession or something. I don't see a recession on the cards myself, but my suspicions might change if we have an emergency cut or an early cut.
Could it be this, Clive? Federal Reserve criticizes living wills of Bank of America, Citi, Goldman, and JP Morgan. Regulators say they found shortcomings in how lenders would handle their own failures. And it's interesting because it says that right here, all four banks had shortcomings related to their portfolios of derivatives contracts, which they and their clients used to hedge trade risk. And I wanted to show you this, Clive. I saw this on LinkedIn from this analyst. I've actually just connected with him, and he talks about how the annual S&P 500 contribution of 10 largest weights during positive performance year. And it hasn't been as high, the concentration as high as it's been since, it's the high since 2007. We know what happened. The stock market topped in 2007. And he notes, this guy, I read here that he thinks what's going on is a lot of option volume, he says here. And I put this together with what the Fed and the FDIC are criticizing the big banks for derivatives. And he says here, while it's plausible that, this performance of the 10 largest stems from macro-driven flows, which means stage of the business cycle disproportionately impacting specific sectors and stocks. It may also reflect structural shifts reshaping traditional financial market dynamics, specifically the proliferation of options and structured products, often entailing volatility selling at the index level, playing a pivotal role. And he says there isn't nearly enough information about privately traded structured products. Still, we can say that the total volume of options trading reached 137.3 billion contracts in 2023, up 64% from the previous year, and the sixth consecutive year of record-setting trading activity in global listed derivatives. So what he's saying here, this is keeping volatility down, but it's dangerous because we don't know how leveraged the over-the-counter market is in these derivatives. So what do you think about that, Clive?
Well, for sure. Investment firms and banks around the world are very anxious to sell their clients derivative type products. Typically, I give you an example, something known as a reverse convertible. That's an instrument where the bank will pay you a certain interest rate above the market. And if the stock goes down more than a certain percentage, you have to buy the stock. Underlying that, what's happened is the bank has literally just sold an option in the market and used that option premium to pay you the interest. And I know that because I'm constantly being bombarded from left, right, and centre with proposals for that. I'm not saying they're good or bad. It's not particularly my cup of tea. And in some cases, these do offer the clients a modified form of risk. But the reality is a lot of people are taking risks that they perhaps shouldn't be taking because they are exposed to these heavyweight stocks, which could have a big dip. We mustn't forget we haven't had any real bad news in terms of earnings. We've gone through, if we go through many years, we've had these large mega cap companies typically beating their earnings number, but that's the landscape's kind of the forecast number. That's kind of shifted now to they've not only got to beat the forecast number, the official forecast, they've got to beat what's called the whisper number. The whisper number is the number that your broker whispers to you. I think, they say they're going to make $1, but I think they're really going to make $1.10. Yeah. And so any failure by one of these or several of these large mega caps to beat their whisper number could result in a very heavy fall in the share price. So I think there are dangers, and we mustn't forget that a lot of you said it's driven by options, but you're right. But there's another factor which is going into the huge rise and dominance of the mega caps, which are now 80% of the S&P 500, and it's this: people who would perhaps shy away from buying Nvidia or Nasdaq or Microsoft or Apple or Meta because they think they're overpriced, and we can argue that. But those who would shy away from it are then talking with their advisor and saying, what shall I buy? The advisors, well, I've got this really good fund. It's done X, Y, Z% over this year, that year, and it looks like a good. And the client thinks he's making a wise decision to buy the best performing fund, which is presented to him by his broker, not realizing necessarily that that fund is stuffed to the gills with the very stocks that he probably shied away from buying in his own name. So because of money flowing into funds and flowing into ETFs, there's more and more money being forced into these mega caps, which has pushed them, I think, somewhere ahead of really where they should be. And it's definitely time for a pause. It's not that I'm saying that the game is over, but certainly a pause. We're overdue for a pause in the mega caps. Long-term, artificial intelligence and technology has got a long way to go as far out as the eye can see. But I feel it's a bit like buying Amazon in 1999, when you'd had to wait another 15 years for it to get back to the 1999 price. It came good in the end, but it was a long, long wait. And we got other companies which were the darlings of 1999, like Cisco and so forth, which I think are still trying to catch up with their prices then. So my word of caution here is you don't want to be overexposed to this area of the world, but I'm not saying this high technology, this high growth area, but I'm not saying that I think the growth is over. I think these companies will continue to go forward in terms of sales and profits, but how long we'll have to wait for the share price to catch up with that, that's another question.
So I've got here the VIX index, volatility index. It's only going back to 2018, but uh, and maybe Clive, after I finish, you can explain the viewers what it really means, the VIX index. In my view,
Yeah, sure.
it's just the measure of how expensive options are. So the cheaper the VIX index is, then the lower it is. It means that people are not really scared of what's happening. They're not protecting their investments. They're quite bullish, so they don't find it necessary to buy put options or to hedge themselves. And if you look at here, the VIX index has been even below where it was prior to the 2020 crisis. And what that guy said that I read about all this activity and options, uh, what I'm concerned about is that there's a lot of financial engineering. I heard even years ago that the Fed, the trading desk at the New York Fed, were going to start using VIX options to try to keep the market steady. So I wouldn't put it past them to be intervening in that, but it's dangerous because I think I see a lot of complacency here, and you see how the VIX index exploded in 2020, and yeah, so I'll let you talk about it.
Well, first of all, a word of warning for any of your listeners who are thinking of buying the VIX ETFs, which are out there. They won't do what you see on the chart, and they haven't done what you see on the chart. The VIX the VIX ETFs always head to zero, and they end up at zero. Okay, so that's your starting point, and the reason for that is it's a mathematical equation which I can't go into here because it's way too complicated to understand. But the fact is, if you look at any of these VIX indices ETFs which have come out, they've always headed towards zero and end up at zero. Then they recapitalize and start again with they do 1,000 for one reverse split and so forth. So don't rush into it. What is the VIX index? It's a combination of the options premiums today compared with yesterday, and then yesterday the debt compared with the day before. So if option premiums rise, it means that people are putting a higher uncertainty on the future. So typically, when option premiums rise, it's because people think that there's something uncertain going to happen. And usually something uncertain is a negative, not a positive. And therefore, people say that a rise in the VIX index indicates a potential fall in the stock market. Now, that graph, I couldn't see the timescale on it, Mario, because I couldn't see the line at the bottom.
Oh, let
But
me bring it back.
there was that huge spike at some point in the past. I'm guessing that was perhaps March
Yeah, March.
2021.
Yeah, March 2020.
So 2020, yes. So in March 2020, in 2019 we had the COVID epidemic just sort of started off in China, but it kind of hit the West by about March,
Yeah.
and everybody anticipated a fall in the stock market. Indeed, the stock market did plunge.
Hmm.
So the fear rose, options premiums rose because stocks were falling and people were so there was two things: stocks were falling, so people were buying puts to protect themselves. The premium was going up, and because they'd fallen, people were saying it's got to go back to the norm, reversion to the mean. So they're buying calls. So the premium went up on those too. So what that was telling us was there's not only an increased volatility, but an increased level of fear in the market. And if you look at the far right-hand side of the chart, in your chart, you can see this rise. So we are seeing in the VIX index, the level of fear starting to rise a little bit at the moment.
One other warning I would have for people who want to get involved in trading the VIX, because this is on IG. My chart is from IG.com, which is a spread trading and stock brokerage service in the UK. And in the beginning of 2020, actually, I started trading a little bit of the options on the VIX because I thought, it's looking really low and we've got all this problem in China and I think the market is overvalued. So I bought calls on the VIX, which meant that if the VIX went up, I would make money. And I did well, and I took a little bit of profit and bought more. And the day that we were spiking massively, I tried to get out of my VIX, and IG.com froze all trading because it was mayhem. And eventually I got out, but not as high. So you have to think about this as well, that when there is a major crisis and the VIX index spikes, your uh, broker's website or internet access they might say, oh, we've got technical problems, right? So you might not be able to get out of it.
Well, you have to remember in times of crisis, stock markets have been frozen. There's many precedents for this all around the world. Whether it be a Asian currency crisis, a Black Friday, Black Monday. When things start to go wrong, they close the markets, and sometimes it close for a few minutes, sometimes for an hour, sometimes for a day, and sometimes for a week, and sometimes until the war has finished, depending on the situation. So be aware that if you're exposed to banks, markets, or third-party custodians, they might, in extreme circumstances, shut the door on you, and you might not be able to get your money. That's why you need to have something in self-custody just in case. And we all know what that is, Mario. You tell us.
Sorry, repeat that, Clive.
What should you keep in
Oh, yeah, yeah.
self-custody?
No, it's just that I was looking at I was trying to find, I'm sorry. I was looking at trying to Google to find when the New York Fed looked into VIX options, but I couldn't find it. Yeah, well, the safest thing is physical gold and silver. And you might have some uh, holdings in the stock market. Yeah, that will take a hit, but your gold and silver will be, well, your gold especially will be safe. I
Well,
agree.
let me try a fun question for you, Mario. If you
Yeah.
were offered the possibility to get into a time machine, which will take you forward 100 years, and are you going to take with you a bundle of $100 bills, some stock in NVIDIA, or some gold coins?
Well, that's a tough one. Let me think. Oh, the third one. Yeah.
Yeah, I think that.
Or maybe a Bitcoin hard wallet. I'm not sure.
Yeah,
Uh,
well, I think those
I
those
would
two will
say
still be here.
I I I mean Bitcoin might still be here, but I think gold will still be here. So I would take gold.
Yeah. If I'm not mistaken, in the H.G. Wells book, the Time Traveler, I think that was one of the items he took with him when he went into the future. I can't remember what else he took. It was some funny things. Maybe he took a box of matches and a box of matches and a camera. I can't remember exactly, but certainly he took some gold coins from memory.
Well, that's interesting. The other thing is, I'm not sure if they still do it, but back during the Gulf War, in the first Gulf War, in 1991, I think, a lot of the U.S. pilots they carry U.S. Air Force they carry sovereigns because if they're shot down in enemy territory,
Well,
uh,
if you read the James Bond books, you'll see that in several of the books, James Bond would carry with him in his belt gold sovereigns because they were recognized all around the world, and he used them to buy emergency supplies and or to pay off people in bribes.
Yeah, yeah. That just wanted to talking about gold. Let's see if Miles Franklin, they're my US affiliate, Clive. Just gonna show the viewers if they're interested. They've got some specials. It's not just about the specials though. You can call them and mention Mario or Monaco 64 and they'll help you, but they always have specials. They've got half dollars. Uh, they call it junk, but it's still silver, $2.50 over spot. They've got 1 ounce uh, King Charles Britannia 2024. Some of you might not like that, but it's still silver. I don't really care if his head is there. I just care about the silver. That's not bad. 329 over spot.
The other side of the Britannia is quite nice, Mario. I like the Britannias. I think, if I'm not mistaken, they have a little hologram where if you tilt the coin, there's a little. Maybe that's the gold one. I'm not sure, but if you tilt the coin, the picture changes into a padlock or a trident.
There's a little thing here. Uh, it's here, a little circle.
That's it. Yeah, that's it.
Tells you if
And
it's
you
real, that's
and if you tilt it, the picture inside the circle, the picture changes from a trident to a padlock or something like that.
oh yeah, that's right.
So just for that feature, which tells you it's genuine, I
Yeah,
particularly like the Britannias.
yeah. Beautiful coin. I've got a Chucky 3 stick.
Okay, yes, good. Well done.
And there's a 1 ounce maple leaf as well, 65 over spot. And I think the premiums right now are fairly relatively low compared to like late 2022. And I think what could increase the premiums is if we get actually a stock market crisis, because and even if gold and silver go down, uh, the real price is not going to change much from where we are now, for example, because I remember back in 2008 when gold dropped like from 1,000 to like 680 in September. I was still working in the city, and I had converted a few of my colleagues into gold, and we were all trying to buy gold, and the premiums were like 10% if you could find the physical gold. So I think it's a good time to accumulate. I think every time is a good time, but especially
Well, let me tell you my story about 2008 and gold. I was working in a bank, and the banking system was failing. So we had no end of clients calling up. Lehman Brothers had just failed, in fact, and no end of clients were calling up and saying everybody knew that Lehman Brothers was going to fail. My friend, blah blah blah, such and such knew it, and which obviously there was a bit of uh, telling people the story after it had happened.
yeah, hindsight.
Because yeah, nobody called me up before it happened and told me. Not even our best economists in the bank knew it was going to happen. But we had clients who were ringing up to buy gold bars, physical gold bars. So what we could do in Switzerland, and we can still do it, is if a client wants gold bars, he doesn't have to be here physically present. He can ring up and say, buy me some gold bars. We'll buy them. We'll put them in his custody account. And when he visits Switzerland next time, he can take them out of his custody account and put them into his safety deposit box inside the same bank. And in 2008, everything was failing. So clients were ringing up saying, please, urgently, urgently, buy me gold bars. Because if you've got gold bars in custody, then it's not cash on the bank's balance sheet. So if the bank fails, the gold bars are still yours. You can still come to the bank after the bank's failed and get them out. The trouble was, we were our dealers, our forex dealers who were in charge of this, were ringing the sellers of gold bars. That would be typically your agent would be UBS at the time, but it could have been Argo or others, ringing the agents and saying, can we have a delivery of 10 or 5 gold bars of a kilogram? And the counterparties were saying, look, we're really sorry, we're out of stock. You'll have to wait 14 days. We're manufacturing them as fast as we possibly can, but we can't make them fast enough because the demand's gone through the roof. And then clients would get extremely upset because they were at risk for the next 14 days if the entire banking system collapsed in those 14 days.
And that shows you how, the price move going down is not because people are selling real gold or silver. It's because there's so much leverage in the paper market, and they just sell the futures or their OTC gold, which is unallocated. And that's why, yeah, that's kind of, how can I say, it's counterintuitive, but that's how gold works. And yeah, so any
So I think
final?
the message is buy your gold if you're into it. Buy your gold while it's easily purchasable. Don't wait till everybody else is trying to buy it because there might not be any available. You might go down to your gold dealer and they'll say we're sold out. Can you wait 2 weeks?
Yeah, that's very interesting. Okay, Clive, any final words to the viewers before the weekend?
anyone who wants to connect with me, I'm on LinkedIn. That's it.
Yeah, Clive Thompson on LinkedIn. And yeah, from me, I wish you, Clive, and everyone else a great weekend. And we'll talk later.
Thanks, Mario. Bye bye now.
Bye.